Okay, testing, testing. Just make sure everything's functional. Oh, look, it's not functional. Hello? Hello, hello? Hello, hello? There we go. All right. So, no, wait, it is functional. Oh, God. All right. Well, excuse the chaos. I'm still getting used to streaming. There gonna be hiccups. All right. So I was just back testing some correlations between the futures market and S&P 500 mini and your typical SPY SPY equity basket. Now, the intricacies of what I'm doing are a little difficult to explain in full detail. However, it can be broken down into two concepts. One, human traders are like noise. Anytime human interaction works inside of any system, it's an emotional wave. As we know, excitement, greed, and buy, and then fear, the other end of that wave or spectrum, fear, sell, and so on. What I have, I'm taking our futures, dividing it by SPY. This shows the respective correlation between the changes on a daily basis. If I take a quick zoom in, I want to show you some smaller details. They have this sort of pattern, this channel they repeat over and over, which you would imagine, hey, these are the same things, so wouldn't they somehow be more of a straight line? Which they are, in a way, when you zoom out, since they are essentially representing the same type of market, just in different ways. Yes, future contracts versus SPY bundled in basket of stock goodies, equity goodies. So in the general sense, we can kind of see, all right, downward, up, downward, up, downward, up, very reflective of a wave type, waveform. However, this doesn't happen all the time. And what I'm looking at currently is before the signs of the crash in 2008. You'll see that it has this noisy aspect over here. So all of this looks like human noise, human interactions, and then huge noise that builds up. You see the trend, but eventually the trend gets where is it, right? So this is natural fear, and then this would be just natural human trading on the left side, right? Now in between is algorithms maintaining a flow, taking out from one, putting into another, rotating certain values. And what it looks like it might be in a, let's see, 84-day period, call it 90 days, call it a quarter, every quarter, 3 months. Well, yeah, every quarter. That's something I didn't measure just yet until now. So every quarter we have this reset where we technically can identify this as a bullish channel as it breaks up each time. And that's what keeps the stock market going up. Now, here's our 2000s. I wouldn't say our algorithms were very good back then, but I do say that they would exist and they would be mixed in much more within the human trading. So you're going to see 99 getting that human noise coming in. And then we still have these algorithmic like patterns on a quarterly basis. And then as soon as it kind of stops and gets overthrown by random extremities, kind of start seeing, you can kind of even see it here. Uh, these are more consistent and filled, while these are very empty on the sides, just kind of pop up out of nowhere. But these are just general trading extremes, like, oh, we're going up, let's go, FOMO. So I'm looking at this correlation, like, okay, this must be some form of pattern. We don't see it as clean back in early 2000, beginning of 2000, late 1990s, 1990s. But we definitely see this for a long period of time, and some can even say that 2007 was cooking for a couple of years beforehand, and we got a couple of years, 2005 to 2007 and a half or so, of this continuous algorithmic, what I would say, postponing, aka kicking the can down the road. Not only as case scenario of raising debt, treasuries being sold, debt being distributed, etc., but there's a whole functional market behind it that's also catering to this kicking down the road aspect until it cannot, right? All right, so I know what you're thinking. Hey, where can we find this again? All right, we're going up. Look at the noise. No chaos. Market only goes up. All right, fine. I don't see that pattern here. Keep going up. I might see that pattern, right? Very lightly, very low flow, low movement, low velocity of movement, money movement, but definitely thin. So considering we were entering a 2018 issue, well, 2020, but there was also some 2017-18 issues. It does stand, it wasn't a big issue, so that's maybe why it's so contained and tight as far as the relation between ES and SPY. And then we got some drops, some chaos comes in, and printed recovery. Now, if we saw that 2005 to 2007 can cook the books a bit, we can also think of a 3-year span where cooking can be quite consistent if it's not exactly for this particular point, 2020. Of course, 2020 was an activating factor of lockdowns. And looking at some other charts, like the initial claims, you'll notice an overall pattern, but 2020 was a extremity that popped in and kind of broke the pattern until it fell back into place, specifically because of the lockdown. So we see this algorithmic slight movement here, got some hiccups, a little bit of fuss, human emotional fuss. Then we got a little bit of more, and we got some more fuss. Then we go back to this non-algorithmic trading, non-bearish channels, and that's when we cleanly go up. Though, out of nowhere, we saw chaos because of the lockdowns. There was no cooking up to this point. It was an event-based thing. Lockdowns were not predicted, they just happened because of a virus, right? Okay, so there's 2020. Now let's move a little bit further. Now it's just so clear as day. And how long have we been in this pattern? 70, no? 70 days? I did zoom in a lot. We've been in this form for a long time. So this is cooking for a long time. And if we recall, 2008, oh, okay, I maybe get 900. Oh, wait, right, the quarter was 90, but the span was, etc., was a whole period of time. So there's your kind of 90-day span again, quarter by quarter. We got this reset, this reset, this reset. And it was a slow but sure upward momentum. And even during a downturn, you may have a little bit extra contribution to the SPY being better than ES, pulling it down. Because if in a division, we got to remember how division works. The number on the bottom, SPY, is bigger, that means that we're going to have a lower value on this 100 index that I've set here. So lower value means SPY dominates, higher value means future dominates. And this is a day by day process. So there's an odd little fluctuation here with a drop, but this is what's really catching my eye. And I'm maybe seeing another, so there's another reset here. And I'm still trying to find out what would be the exact sign. And all I can kind of see is when this pattern stops happening. Is there a predictive nature to it? Is there something that happens before that'll show when the pattern ends? In our case for 2020, there's nothing we can do really to analyze it simply because 2020 was a surprise. COVID. 2018, we had that similar pattern. Then we had some kind of interruptions, ups and downs, a little bit of more human emotional saturation, and then a drop. 2008 was really the biggest uh, sign here. We had a 900 days of consistent ranges, and then it picked up on the bottom side, SPY. And it looks like based on the two here, as far as ES, after SPY had a little winning section, futures had a little winning section. Then there started to get more volatility, and then more volatility to a point where our channels get lost. And then it just becomes a mess of emotion, of course, with huge highs and huge lows. So maybe we're going to start to see some form of, if not, another lockdown because we have more things that are happening based on cows and birds being infected. When we start the breakdown of this channel, that should be your red flags. We saw the breakdown of these channels here. I don't like this. Somehow, this is not a very nice, clean area. I wish I could zoom into that. And I'll have to see if I change this to percent. Regular. Uh-huh. Okay, that's fine. That's better. Yeah, okay, so we saw that same climb, the channels, while it goes up. We started seeing break in consistency. Then we had a break in the channel. And it's basically noise from here on with the general sense of these channels being still in existence, just not as clean on the volume side, not on the price range side. Saw the difference between a algorithmic channel versus human emotions. We see it consistently in all of these examples. So, what I'm thinking is, especially during the actual drop, you see extreme emotions happening. And then you still have, so you had that drop 2020, you had a check mark recovery. Those channels do not get built up, and you can see how they start happening right here. It starts to build up, it starts to build up, it starts to build up, and then boom, like clockwork. And I'm assuming it's because of the transfer of shares being given to particular locations that are now increasing their influence on the market. People having fear, selling their shares. The person who sold might have these algorithms, and boom, we get back on it. It will take quite a lot of volume to get to a consistency like this. And now we're kinda okay. Well, we did have pretty intense bar right here on the sell side, downside movement. And this was where the futures contracts had a big burst and then calmed down volatility wise. ES was pretty consistent, but you can even tell just how these channels work around these particular patterns, these quarterly patterns. So that's the sign. These tight channels is the sign that we're in a volatile situation. And when we start breaking out of those channels, like here and here, both sides in that case, here only SPY did. Here, I would say we're waking up. Normally, in the beginning of these channels, it's pretty contained. Even though it can fill in the channel, it's still contained, not a lot coming out. This one, we got some bars starting up, trying to cool down, and now we have huge kind of outside settlements outside of the channel. Each time the red bar came in, it started at the top and then went down. Started at the top, went down. We didn't have a green bar go up outside of the channel very often, if at all. Maybe here, but here it touched the top of the channel, fell back down. So not a lot of these green bars that start from the inside of the channel and break out. And that's my current research. Taking a little step here. So all the greens always come, well, all the red bars start top, go down, green bars start bottom, go up, and they all try to close within that little space, that channel, quarterly channel we find here. Now, again, this is where it starts getting a bit more obfuscated. Can't quite tell where. Very volatile. This was after our downtrend in 2022. Arguably, we haven't. Arguably, the last 4 years since COVID have not really played out the way we should have. Just like 2008, getting bailed out is not a natural format. Getting bailed out sure will return the channel upwards, giving more pricing power to the individual banks that are playing in this market. However, with those interest rate manipulations, low interest rates gives people the ability to lend money to keep surviving instead of focusing on their product to make profit to survive. And if you're not making profit to survive, what are you doing? Well, you're what we call a zombie company. You're living off of debt, lent money. People are giving you money and then you're paying it back just to keep existing. And because we've been saved so many times by the money printer, there's another comparison of charts. Of course, one of them being for COVID, the other one being 2008. We got saved at the moment in time that we could have seen a pretty decent reset. In fact, we just went below 2000 after the 2000 crash in 2008. We made a lower low with technical analysis. When you make a lower low, you enter a downtrend. In the general sense, you want to fulfill that downtrend until it naturally exits that downtrend from the free market. So if we had a downtrend here, and we don't have any extra data. Oh, that's nice. That's nice. Well, let's remove one of these. Let's observe just a single chart. Ah, SPY. Okay, cool. So downtrend would have potentially, and yeah, okay, we did touch that top. It's pretty decent. But notice we've never tested any of these, which is kind of scary to think about, especially in 2008 versus today. We never did a natural return after a blow up, after a breakout. Never did a return down to test and then continue forth as naturally as it should. Technical channels are there for a reason. They work on the minuscule scale and they work on the macro scale. However, we've never done this tap on our resistance here. So that's where technically, if we were going in a downtrend, I would have seen, we would have seen our market from the top of 150 155, go down to 50, which would have been a 66% crash versus a 50% crash, right? So it's not that horrible at 150. So we kind of played around here. We can see that these two are basically check marked. We shouldn't have to see these prices anymore because of what would technically look like a double bottom, but maybe they didn't make the double bottom as they wanted to, and therefore prompted the printing to take over. Because it does look like the algorithms, as we saw here, I don't have that anymore. Right, right. Well, I'm looking at SPY. Oh, right. Wait, hold on. How come this is always SPY? How come when I change that? Oh, yeah, how come when I put those together, the chart removes this section? This was just regular SPY. It should only just be SPY, so it's kind of cutting it off because the bottom chart is getting cut off. Why would you cut off a chart that has history just because maybe futures doesn't have that history? And this chart should be the actual data between the division of these two. While this one is just SPY, just SPY by itself. So why does SPY by itself still factor in futures rotations? All right, that's weird. So yeah, so there's your robotic movements. That's what I wanted to check. They got to a point where they almost made a double bottom, but because it broke the low, they got pretty scared. And when you get to this point, you're going to see continuous drops until the test that was necessary back here that we don't see anymore because TradingView is obfuscating data because of, I guess, maybe chart relationship. I don't know. Either way, it could have been a double bottom. That's what they were looking for because you can see they started to take control here. In fact, specifically here, but they lost control potentially because they built a bearish channel trying to take control. Okay, I gotta change that. What? Look, where we at? Why are you moving around? So yeah, I can kind of see. No, what did they do? They had. Oh, I see, I see. They try to make a reverse head and shoulders. That's what they missed out on. Reverse head and shoulder here would have helped them. They missed that chance and they made a lower low, which would have prompted a further leak down. Depending on their liquidity. No, no, hold on. That's the first set. That's 2000. That didn't need saving, or maybe it did. Can't remember what happened as far as printing fiscal policy then. No, they were trying to build, yeah, that's what I was saying before. They were trying to build a bearish channel and exit upwards as it naturally does, which it did eventually, but it did because we had to experience a big drop here and then money printing happened. Buybacks for banks. If you don't remember 2008, 2009, the banks got money, they bought their stock back very quickly, and then we went back on our general trajectory. So yeah, I'm kind of just taking some time finding patterns between previous events. And it does happen to be that we start seeing these robotic movements, literally a saw wave, if you know music. I think it's a saw wave. I don't know music that much, so I'm not gonna pretentiously say I know much about it, but I know there's certain types of waves, and some of those synth waves are saw based. They go up, down, up, down, up, down, up, down. Very sharp. So we start seeing that, and then after this, we see some, well, noise, a lot of noise, emotional human noise. Then we should expect, especially if we see a downtrend. And the thing about it is, a lot of traders are going to confuse the downtrend for a bullish channel because look what it's creating. Oh, look, we're getting ready for another blow up top. This is where fundamentals, or sorry, technicals fail. You can't trust technicals all the time. You can only incorporate as many pieces of information as possible to try and optimize the risk reward of these combinations. Each one will have a certain weight to your risk and to your reward. Just following these technicals, they don't necessarily just one channel, just this bullish channel. You know, you've went through so many YouTube videos and you've seen all these channels always go up. They always go up. And what's the opposite? It's this one. It's when you have a channel like this and it always goes down. You know, it doesn't have to crash, but it's going to go down, break down, and redo itself and have another trend. So while this is natural, this is not. Considering the actual event, we broke it down from a bullish, it should have went up, but it went down. So because technicals are very, very widely used, they're also subject to manipulation. Don't expect it always to happen. If it's purposeful manipulation or simply emotions breaking out and everyone selling because of an event that happens. So we don't trust them as a singular form, but you want to have multiple technicals underneath your belt. So everything I've done here is just technical analysis. I'm not even talking about potentially looking at fundamentals. Where's our debt? What's the money velocity? What's the dollar doing in comparison to the world DXY? What's oil doing? You have to have a well-rounded perspective on not just, oh, look at lines, they're cute. They do stuff that they do over and over until they don't. I don't want to say it, but because as far as the technical goes, I don't really want to say that because it shouldn't happen. There's the chances are so low that it would happen. But since we never tested this downward location here, we simply just went on our way. We broke up and we broke up again. And you can see that, yeah, maybe we don't test the next breakout to this particular line here. But eventually we test it. We go back down to it. There it is. The tested was confirmed. Therefore, let's just keep moving up. This was also a case, though, for the money printer being involved here. It reversed the trend. Banks bought their own stocks, and that inequality just shifted intensely. The case scenario, the excuse was, oh, banks now have the ability to lend you money again because they were under constraints, so we gave them money so that you could continue business as usual. Maybe 10% of what they got. The other 90%, they bought back their stocks, changed the market. But because this is not tested, this never came back down. It should have potentially, healthily, came back down here and then had the rally it did. And then we'd never have to see that bottom part again. And then maybe if we tested this here early, then we can just continue going up like normal. If that was the trend that we saw that we had a nice firm test here and then a firm test here, we're just stepping up, staircasing up, and it would continue. But markets aren't as predictable as that. The only thing that worries me is that we haven't tested this bottom location. That's $50 for stocks, guys. I don't want to say it's going to get there. There's such a low chance, and there would have to be mass chaos for us to reach that point. But I mean, What's the other one we haven't tested? We never came back down here. We haven't tested this one either. Now, this is unique in the way that, I mean, maybe we can say, oh, okay, maybe it did test. I guess this kind of counts. It's kind of short term. So maybe this is mild test. Because normally I trust long-term tests more than something that happens very quickly. But notice how it did this. It went up, broke up, tested, and came back out. Fine. That's natural form. If you look at smaller technicals, though, normally the consistent test is one, two, and then three. So another extra test, which doesn't have to happen. This one for sure does not have to happen. But this one naturally does in most technical analysis of charts. The other thing was weird is this. You had developed a megaphone here. A huge range, which normally would break down because it's a case scenario for volatility to come in and soak up the market of excitement and then breaks down. It's another type of technical, the megaphone. Not very common, but it happens once in a while and it's not very predictable, maybe 30–40% reward, 60–70% risk. So I don't use megaphones very often. One could assume this is a test, but what is it testing? Bottom of this testing midair. The other one here kind of testing the previous channel, but such a small channel it shouldn't require a test. So this particularly, that's my actual might happen situation. 210 versus this one that didn't get tested here from 93, 95. That one has, I'm gonna say, 0.1% chance of happening. This one, I would say has 20–30% chance to happen sometime in the future. But geez, I mean, that's the problem, right? The market is absolutely out of its mind in printed money and stimulus. And natural movements have been obfuscated. And as time goes on, inflation happens, and printing happens, and events and profits. So all of those contribute to this previous resistance with profits and next level inflation and investments and closed positive positions and making money. Now, there's your next top. This one didn't quite touch it, so let me see if I'm lining this correctly. Is my phone going crazy? Oh. Mm, kind of wanted to break out. Touching there, touching here. 2015, nothing of value happened there. Maybe I'm not too. I need to go back in some history and see if anything happened here to change the trend like that. Other than a technical that we can see here. Another bullish exit upwards right through a strong resistance. Tempted here, so maybe we just tap the top, maybe, but it's so odd because it's a perfect top tap, and I'm being biased. So in reality, I try to get as many points to touch as possible. One, two, three here. Four there. Five. Um, this was a previous resistance too, or support resistance. So we had a megaphone happening here too, now that I notice it. So something may have happened here to change the trend. Something may have happened here to change the trend. And then we didn't actually reach. So either we have another, there's our support, we have another attempt to touch it and get back off, or we didn't touch it, therefore liquidity is missing and there's issues in the market. And this is actually a downward spiral. Not spiral. We'd be looking at here for the first tap, 522. Might take months, a year. If we can bounce off of this, we'd healthily go for new highs. But my assumption is they're going to try and tap it here, never testing that bottom there. Because if you look at other details, there's a lot of gaps, a lot of gaps underneath us. Oh, there they are. Got a gap at 290, we've got a gap at 338, we've got a gap at 397, and a bunch more in recent times. 442, 431. It's in the weekly, so I gotta change the daily to show them where they are. 424, 433. So those are gaps that, I mean, it's like an 80 something percent chance. Gaps bigger than 0.01%. In our test, we're going to back and look. Bullish gaps 59, bearish gap 61. Okay. Depends on the size of the gap too. The bigger the size, the higher chance it's going to fill. That's a 0.6. Positive gap's bigger than that. Positive gap bigger than that. We're falling to charge for some performance. Yeah, well, that's recently too. So how do you incorporate that until you see it happen? Where's the 33 bearish gap is 33% chance, bullish gaps. Finally, we take a look at larger gaps of 1% or more. Well, yeah, of course, not the first day of trading. It can happen at any point in the future. So bullish gaps have a chance, 60% chance of filling out of 2,155 instances. For instance, 20% of the 27 gaps were filled. We're running the test, we have falling statistics. We're not here. We're not here. Kind of between these two. 0.6, some of them are less. So yeah, between this and this. At least 0.5. So they have a 43 to 42% chance. Bullish bearish. So that's less than 50. That's fine. Not always. Can't say always. Data shows there's statistical data that shows. See, this gives me different data that says 91% chance. There's statistical data showed that nearly 91.4 gaps get filled. However, there are some caveats. Securities selected for the study were all index stocks. Right. So indexes have a higher chance of getting filled. Okay, so if you're incorporating every single stock, of course you're going to bring down the percentage down from 91% to like 50 because you're including stocks that potentially never have their gaps filled. But an ETF is a basket of stocks. It is more dependable to fulfill certain patterns because more traders are there. And if you really think about it, I say this all the time, technical analysis isn't more than just psychological analysis. What do people do when they see certain types of trends? That's all it is. In fact, if you go further, it's statistical psychological analysis. What are the chances of people that'll do this when this trend happens? And then you're working with risk reward. 91% of gaps should get filled in index stocks with an upward trend. SPY, QQQ, NASDAQ. Okay. But the overall research indicates the stocks tend to fill the gap eventually in 9 out of 10 cases. So basically, there it is. Is this stocks? Did stocks turn? Let me get the stock. Eventually. So eventually, I guess it's like future, wherever it happens, a crash happens and it fills the freaking gap. I don't know. Right? So those are the big pieces there, but you're still looking at 90s here. Let me do my little AI, couple of AI. Let's get an average of all these sources. I'm not keen on having one source as my final verdict. What is the probability of a gap being filled? Specifically also between index funds and individual stocks. Is there a difference? What's the difference? And what are the percentages involved?
Searching for probability of gap being filled in index funds versus individual stocks. The probability of a gap being filled vary between index funds and individual stocks,
Get that.
and there are some differences to consider. Key points. 1. Probability of gap filling. For individual stocks, about 63% of gaps tend to be filled. This can vary based on the type of gap and market conditions.
Individual stocks.
Index funds, being collections of stocks, may exhibit different gap filling behavior due to their diversified nature.
Right.
2. Differences between index funds and individual stocks.
No, I don't.
Volatility. Individual stocks are generally more volatile than index funds,
Okay,
which can lead to more frequent and larger gaps.
right.
Diversification. Index funds are less likely to experience large gaps due to their diversified holdings,
Right.
which can mitigate the impact of individual stock movements. 3. Factors influencing gap filling. Type of gap. Exhaustion gaps are more likely to be filled than breakaway or runaway gaps.
Exhaustion,
Market conditions.
volume,
Market
liquidity.
trends and investor sentiment influence the likelihood of gaps being filled. Understanding these differences can help in making informed investment decisions.
Thanks.
If you have specific stocks or funds in mind,
Summary was if it's assigned to individual. Yes, that's the percentages. No percentages from this AI. Oh, well, there's another case for it. 90% getting filled index relatively high due to diversification. So yeah, individual stocks, we can kind of go to a 60%, 70%. But ETFs, that percentage is far too high to be considered negligible. All right. So if we even estimate or average it out, call it 80%, kind of my original assumption. 80% of the time, these gaps should get filled at some point in the future. Now, this one's pretty small. So I wouldn't even count that one, but that's still when you have this one down here that was what, 0.6%? 0.5. Still bigger than that 0.5 threshold. This is 0.8. Yeah, base. Not even. This one's nothing. Just kind of highlighted the fact that it's there. The 0.02. That's not. What else? This one was a big one, and we're kind of half filled it and didn't quite fill it yet. So yeah, big gaps, big moves. Oh, okay, that's a 0.7. Too crazy. It was a 1.2 until this bar here filled in half of it, 1.2 now to 0.66. But that's kind of the thing now. We started the process of fill, filled with that bar. Now we have a gravitational pull, price pull, to try and fill in the gap, potentially drop on this support, 577. Now, if we do that, we're going to break down other technicals. Like we're already down underneath the 28 SMA, the 50 SMA. If we break down below the 100 SMA, that could be even more selling pressure that then we have to contend with a support here at 562, potentially this 200 SMA coming in, balancing out here. Potentially, whatever it does, it might get a little bit of a buy boost because now bouncing off of this 200 MA is a very common theme. If we break down below it, though, very no bueno. Well, okay, we broke down below it here. We have three bars, one, two, three, four. So this would have been a bearish, but came back up 23. So we do have some range underneath the 200. That's also because we just came down from a mini crash of 10%. Was it 10% correction? 25% correction, 30% correction, almost. And that's why that 200 was a little bit difficult to give it space. We kept coming back to it, so we have a high chance of coming back to it again. Which will basically be repeating this right here. Downward trend. Or a bullish channel because it breaks in the bullish direction. And it may go just a tad bit below 200. Tried hard, tried very hard to maintain. There's your ceiling. Stopped right at the top of the channel. After hours don't count. There's some sketchy stuff that happens in price action. Still broke below pre-market. This should have been during the day candle. Boom. Boom. Still being attracted downward. Right, okay, so that seems to be a pretty decent channel on multiple time frames. Just a little bit there. We'll match. Yeah, there we go. Broke below, attempts to go up. Hit the resistance of the trend. Opened up the next candle above and continued. Attempted again. Here's some signs. I don't have to make it perfect. This is pretty ideal here. Sometimes even further trends adjust it. So sometimes you can only do so much with so much data, but it does look like a downward trend that kind of broke down. And this was during the Fed meeting. This was during Jerome Powell giving us a cut as expected, but didn't quite satisfy the future cuts that were going to happen. Instead of 4 cuts next year, he was predicting 2. And in those cases, he Historically, it may even just be one. So because of those 50 to 75% chance reduction in cuts, and remember cuts help businesses lend money or get money lent. We talked about this in the beginning. Lower interest gives you more money because you can pay it off without losing a lot of premium, without paying a lot of principal. And they're hoping that it can go down and maybe balance a little bit of the book sheets because they've been having some rough times since COVID. But they didn't, they expected four cuts next year. We're only going to get one or two. And that's what this big red candle was about. We came back up, spotted resistance, but we didn't close above the SM, right? Yeah, we closed above the SM. Is that a gap down? We opened up down here, played around, touched the top of the gap. Oh no, filled a little bit. Yeah. Filled the gap from the bottom up. So it didn't drop enough to fill the rest of the gap. So we started here, went up, and then we kind of build a new bearish channel. A little messy, but human emotions tend to do is mess up consistency. Drop down. There's your gap down. And we had a bullish move up. We didn't spend, and that's the thing, yeah, there was no particular trend here. So at that moment in time, this was just a bullish trend here that it broke down under. Because naturally, bullish trends tend to break up. If we do break down, there's a high probability it's going to come back in the channel and set itself up for a break up. So not only did it do that, then it started forming slightly this bearish channel in the process. One thing leads to another. But those are old things that I've looked at. We don't need to look at those. The final result here is that I'm expecting, you can expect whatever you feel like you're expecting based on the news and all that, but based on my general risk reward flow, I'm expecting potentially more bullish movements, but it's going to be within these branches. Potentially even going up here, testing, falling back down. And I'm waiting for this MA 200 to see where our bullish channel and our MA interact for the next possible bull run. If government doesn't shut down, hacking doesn't break our system, our infrastructure, our treasuries because they got hacked recently, if all of the non-technical details, aka fundamental details, are smooth, this is what I'm expecting. Uh, but you can't really predict the black swan. You can only try and prepare for hedges. So there's my interesting analysis. A lot of little details in here, a lot of trend analysis, specifically technicals. I haven't even gone into the volume of things. The volume generally has been going down as the direction has been going up. So that's a long-term divergence. Long-term divergence. The volume and interest is going down, or AKA, we're all in the market. Who's got more money to put in the market? Do you? Oh, you're already in? Okay. Do you? Oh, you're already in? Oh, crap. Oh, we're all in the market. What do we do now? Well, let's advertise to foreigners. But they're going to be the first ones to leave when stuff hits the fan. So you've got global markets now, Revolut being one of the ways you can basically contribute to the market liquidity from a foreigner's perspective, so on and so on and so on. So there's that. That's all I wanted to go through. Thanks for dropping in, seeing some details. I don't know if you're a trader or not. I do a lot of stuff on my channel. I like to entertain. I like to educate. I like to have a diverse set of stuff. Maybe I'll do multiple channels in the future if it gets too crowded and I get complaints about it. But thank you for dropping in. I hope you got some valuable nuggets of knowledge in this live stream. I might make this into an actual video and maybe cut it up into more nicer pieces. But if you need any training, if you need any education on statistics, on mathematics, on computer science, on programming, on building your own artificial intelligence system on your computer, this is my own application using Python, using Olama, and a bunch of different APIs, etc. There's a short answer that I just clicked on right here. So if you need programming help, if you need stock market understanding, economic, macro, micro, like whatever you need really. If, I'm just a person that absorbs everything I read, um, and I love to learn. If I go one day without learning something, it's a waste of day to me. So it used to be where I used to play a game every day, and if I didn't play, I'd be unhappy. Well, eventually I swapped that up through habit. And now if I don't learn something a day, I'll get unhappy. So I'm constantly stuffing information. Like my next projects are actually Godot and Blender. I want to attach an AI. Oh, I have to look up where my stuff is. I want to attach an AI. Where's the thingy? To go back to this, it's been probably a couple of weeks since I worked on any of this. I want to attach an AI to a sort of a 3D modeled system where characters reenact storylines in a comedic fashion based on user input from Twitch or YouTube or something. We'll see how that goes. That's going to take some time for me. I'm a back-end developer. I'm just getting used to GUIs and such, and especially getting into the 3D world of things. Why isn't that working? I don't even know where I placed all those objects. Oh well, that's for a future thing. So, thank you for coming in. Thank you for watching and hearing me babble and tangent all over the place. And if you need any help for learning, details all over the place, superscholar.xyz. That was probably the longest plug I've ever done. If I don't even do plugs, I hate doing that because it makes me feel ugh. But you know what? Welcome to life. So, superscholar.xyz. Find me on Twitter. I keep up with the market based on serious market, industry, economic details, and societal issues. So, I'll leave all